Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for August 9th of 2026. Start off the chart pack this week talking about AI spending and capital spending and kind of the implications here. Got a few charts from Apollo, which I thought were pretty interesting in the reading package for the week. So here we have expectations for capital spending for the hyperscalers for the next 3 years, and there is some dissent on this. So this is just Apollo's interpretation of the consensus forecast here, and you can see the gradual ramp over the last couple of years, and the expectations are very high, and so there's a lot of expectations built on this and also there's a lot of risk that's built on this too. Now, is this capital spending going to translate into earnings and return on this investment? And I think that's really the big unknown at this point. And so there is increasing skepticism that for all the spending that's going to take place in aggregate terms, that there's a huge dependency on those downstream profits from that. In fact, a profit dependency that is far in excess of current profitability for a lot of these firms. So this is another interpretation of capital spending here, and this is looking at it relative to the telecom cycle in the late 90s. And this is a time that I remember actually very well, and it represented a definite bubble period in the technology industry as the internet was just getting itself entrenched in our conscience, and e-commerce and all of that back in the 90s. And so obviously you had technology spending that had to increase to handle this new thing that we called the internet back in the 90s. But as you can see here, hyperscaler spending expected, looking ahead over the next several years, just as a percent of GDP, is going to be likely far in excess of what we saw from the capital spending cycle of the late 90s heading into the new millennium. So this is looking at capital spending through a slightly different lens. We've got data here from FactSet and Refinitiv that look at things on a year-over-year basis. As we look at the left-hand side, here we have the aggregate spending levels in this gray line. You can see that they, just as that prior chart indicated, continue to rise, although the rate of gain is expected to drop. Now, again, in the face of rising aggregate spending, maybe this doesn't tell us a whole lot. It's just other than to say that we had an extreme acceleration of spending here over the last year and a half or so, and the aggregate spending levels are expected to continue to increase as we've seen. Now, as I alluded to earlier, the big what if is whether cash flow from all these investments is going to be positive. And here's expectations for free cash flow looking ahead, particularly when we get to 27, 28. Now, this is the big unknown, but it's where skeptics love to huddle at this point in time, saying that there's no way that we can get the returns on this, all of this investment. And again, this just represents consensus estimates. So if this is true, and again, this represents zero, so the implications are that you're going to have negative free cash flow on the part of really all of these folks except for Microsoft, because they have a very strong consumer-oriented business to help support their losses in the AI space. But in any case, we're going to have to navigate this over the next couple of years. And when you look at expected returns in the market, and obviously the expectations for earnings growth are pretty robust heading into next year. That's looking at 27, but when you get into 28, we just don't know yet. This could be kind of a choppy period for the market as we kind of like position portfolios for kind of that 2 to 3 year horizon. But again, if you believe the long-term productivity gains that are born out of AI investments and the long-term economic model that is being presented to us now by these hyperscalers, then it would be easy to see where free cash flow turns positive in those out years when you get 3 to 5 years down the road. Now, as it relates to the AI sector, this is probably one of the most intuitively interesting charts out there, and it really puts things into perspective. Where this risk is. Because you've got all these positions along the food chain. So when you look at models and applications, I mean, obviously a lot of R&D, a lot of development, a lot of spending to get the platforms ready, and margins are terrible right in that area right now, but that's to be expected. It's early stage. Then you get into the computing and the cloud environment where these applications sit, and these margins are positive. And then obviously the energy that supplies the computing power and the data centers, those margins are positive. And then when you get downstream to what's actually going to power all of this and have it communicate with each other is silicon semiconductors and the equipment that those are housed in. So what's interesting is that the most profitable sector in this AI food chain is entirely dependent on the least profitable sector to continue to grow. So let's kind of put this in layman's terms, like all of the capital spending is being applied in this area, and and then to some degree along this chain here, but all this capital spending is driving expectations in here, and so you've got the profitable areas of the food chain that are wholly dependent on continued growth and recovery and positive cash flow out of these areas here over time. Now we talk about data center booms and how it relates to our trade balance, and of course our trade balance is like basically gone up 3x in a very short period of time. A lot of it has to do with this, and I thought it was interesting digging into Bloomberg this week and trying to get some additional perspective that here we have basically exports of computers, accessories, semiconductors, and then here's imports, and so that has driven a fairly significant trade imbalance that has, you can see here, has really kind of almost accelerated because of this. Now, this is something that the administration is saying we want to correct. We want to have more exports of AI, but again, you've got these national security concerns and whatnot. So I think it's going to be hard to reverse this in fairly short order. So again, this is contributing to overall trade imbalances. But the good news is that we have a massive trade surplus in services. So when you think about basically hardware, computers, accessories, semiconductors, that is a trade imbalance right now, but we have a huge surplus to offset that in the services sector. Interestingly enough, China, and we probably don't spend as much time on China as we probably should, but again, China, for all of these demographic issues and kind of like internal economics, concerns that we have, they're still driving a pretty heady trade surplus here, and that you can see here that has almost unabatedly, except for a period here, 22, 23. Just continues on a long-term basis to expand. You see imports basically flat as China, for the time being, has kind of essentially abandoned its consumption strategy and really focused on the export-driven model that they have founded themselves on post admittance to the World Trade Organization. As we transition into domestic economic concerns, here we'll start off with the Institute for Supply Management Services Purchasing Managers Index, the PMI, Services PMI, still very solidly in expansion territory. Good news here, new orders looking fairly strong as well. Again, looking at this, you wouldn't have any concerns over our economic situation right now, and I'd say by and large, the economic backdrop is actually pretty favorable at the moment. Now we have some data from S&P Global looking at US PMI. We just talked about the services sector. Now we'll emphasize that within the context of the manufacturing side of the equation. You can see both of the most recent readings were ahead of expectations to some degree. Both manufacturing in the black line here, as well as services in the blue line, remain solidly in expansion territory. Again, this is something that's been playing out for quite some time with, a little bit of oscillation here, but by and large, very positive readings, again, conducive with economic expansion. One area that we really haven't spent a whole lot of time with lately has been the labor market and all of the laterals, right? Because this is one of the primary mandates of the Federal Reserve in their rate decisions. And, we think a lot and talk a lot about the inflation side of their mandate, but not as much on the employment side. And really, there hasn't been a tremendous amount to report here, but I think there's some interesting internals in the labor market right now. We have positive productivity. Again, we talk about productivity in a very broad sense. A lot of people talk about the eventual productivity coming out of AI. I think that's probably a couple of years away when we really begin to see that boost. There's a lot of spending by companies in advance of seeing that productivity. But again, productivity looking fairly strong. This dotted line represents a trend. Trend is favorable. Here we have unit labor costs, which, maybe we've seen a little bit of moderation lately, but again, the long-term trend, this year-over-year line in the blue here, slight uptick 1.4. Again, that's below the rate of inflation, so that's positive. Again, this is unit labor cost, not earnings. We do know that real earnings are still at the moment trailing inflation, so real earnings growth is not positive right now, but labor costs remain fairly low in terms of the rate of growth. Here we have initial jobless claims. This kind of gives you the real 50,000 foot level view on the labor market. We've got initial claims here. 4-week moving average continues to drop 200. Fairly strong environment, right? Continuing claims that has dropped for quite some time and picked up just a little bit. But again, when you look at 1.8 million here on a continuing claim basis, that's obviously looking a lot better than what we saw, back in 24 and 25. Challenger job cuts, you can see year to date here in this blue line and where that's tracking. Again, this is a clustering of data over many, many years, and you can see that we're probably erring on the lower end of that historical trend line, which just indicates that there just haven't been very many large announcements. Challenger measures really the largest corporate cuts in labor. But very interesting here, we've got layoffs and discharges from the JOLTS number. So this is the job openings data from the Bureau of Labor Statistics here. And that did indicate a little bit of an increase. So again, it's not uncommon to have some data kind of seem to be in conflict with each other, but a lot of it has to do with how these things are measured and what's actually being calculated here. But just to say that as much as we feel like maybe the labor dynamics are pretty benign right now, that when you dig beneath the surface and get away from the big company environments and just say, let's look more broadly, that there is still a little bit of stress out there in terms of job openings and job cuts. So again, not everything is rosy, but it's not a particularly bad picture either. Here we have the unemployment rate, the headline rate here, which is in the blue. Again, we've seen a little bit of moderation overall in unemployment as it's calculated. Interestingly enough, where we do get pressure and where we've seen pressure continuously over the last couple of years has been in the college graduate area. And, they define college graduates all the way as individuals all the way up to the age of 27. And so you can see, that kids getting out of college ostensibly with a lot more debt. And of course, after the moratorium ended, kids are having to pay their student loans off. And, again, this is where you're seeing some stress in the emerging labor market, as I call it, the emerging generation. They've got, student loan debts. They're having a little bit more trouble finding jobs. And obviously, housing is largely challenged in terms of its affordability right now. And then now we look at non-farm payroll growth. Again, against the backdrop of maybe some overall moderation in the overall unemployment rate, you're seeing a little bit of uptick in new job creation. So again, you've got the JOLTS data, which seem to indicate that you've got some increased layoffs that lay underneath the surface with small and medium-sized companies. But overall, you're seeing job creation remain positive. Now, the other thing that I think is worth discussing here is, the data as it's revised. And so this is something that has been, I think, not getting enough press either. So as much as we say, like, the current data seems to be, not, particularly negative, you've got to remember that, data gets revised once it's initially released. And where we've seen here is that, May data, we had 66,000 jobs that were revised away, that were taken away from that calculation when it was revised, and 37,000 back in June. And so when you look at the weak number that we got in job growth from July that caught everyone's attention, then you say, all right, fine. What that tells me is we're growing, but we're just not growing very strong. And against the backdrop of all these other things, unit labor costs, et cetera, you get to a point where the labor market just seems kind of at a point of very low growth, which again you take two steps back and say, well, what does that do for Fed policy? Well, that doesn't necessarily, if you're thinking about inflation, yes, at one point you were more tempted to want to promote rate increases, but you certainly don't want to torpedo the labor market. And a labor market that seems to be in a point of kind of like benign growth it's a very tough place to be if you're a Federal Open Market Committee voting member in wanting to vote to put any more stress on the labor market as it sits today. Labor force participation is definitely an issue. This is something that I think we're going to be talking about for the next decade, really, when you talk about an aging workforce and the fact that a replacement rate is dropping. We need to, every couple needs to have 2.1 kids to maintain our long-term labor supply, and we're not doing that right now. And then I think what that means is that people are going to be working older. We are living older by and large, but I think we're going to be inspired to want to work longer. And here we've got participation, and this could have several implications, even though the percentages here don't seem overly significant when you think about the fact that this represents millions of workers. A percentage point change here and there can have a fairly tectonic aggregate meaning. And so either you've got discouraged workers or you've got just aggregate unavailability of jobs for many folks, and that's certainly not the case, because we do see that we've had positive job creation, but we've just had this consistent drop off here over the last year and a half, and it begs further inspection by economists far and wide. Average hourly earnings. This is what I was talking about. We've had a little bit of a decline. When you look at it year over year, this is private employees. 3.15, again, that's below where we're seeing the rate of inflation now. So real wage growth is back to being negative after having turned positive for a while. Obviously, from a purchasing power standpoint, this is important. Directionally, this is important because it continues to go down in terms of its rate of growth. And so, at a healthy economy, you're going to see that at least flat or at least keep pace with inflation, even if directionally it's moving the wrong way. Something else that I've been watching with regard to the labor market, you can see that we're spending a little bit more time on labor this week because, frankly, we just haven't spent a lot of time on it, over the last several months. But this is kind of a breakout between full and part-time, and we talk about in some cases at some points in time that there are a lot more part-time workers that want full-time jobs. And that's, we call this kind of an underemployment scenario where, you want something that's full-time, but you can't get it. So you take whatever you can get. And you can see here that, we've got full-time jobs are in the orange here. And you can see that we don't have as much positive development here as we do in the part-time side. So this is another one of those internals that, when you dig down below the surface and you say, oh, the labor market seems to be reasonably okay, if not really growing that much. And then you look at some of these internals and you say, well, all right, fine. We're just not creating as many full-time jobs as we would in an economy that is really driving a lot of sustainable growth. Now we talk about retail sales. Here we have latest data, basically flat, coming off a couple of good prints here. Again, inflation adjusted retail sales, and this is ex auto too. So it takes a little bit of volatility out of the number, even though this is an inherently noisy data set. But it just kind of represents, some reasonable growth trends in retail sales. We've had some really good data over the last couple of months, and so when you see a month like this, it's not terribly unexpected to see something that's relatively flat. Now, translating all of this over into how company CEOs feel, confidence, I'd say, remains guardedly optimistic. It's not robust, but it's not bad either. Now we kind of condense all of this recent data, and not just what we've talked about this week, but over the last several weeks. This gets all factored into the GDP Now calculation that I talk about a lot. This comes from the Atlanta Fed, has very good predictive power. And with everything I've said about maybe the tepid labor market and retail sales that have been reasonable, and all these collateral data points, that we're looking at 5.8% for the third quarter, and that is astounding, absolutely astounding. And that is obviously something that we couldn't have predicted at the beginning of the year, nor do we want to get overly excited and extrapolate into the future, because I do think, and we saw this, a little bit earlier in some of the hyperscaler data and the free cash flow data, that that we're going to be seeing little air pockets where we're just going to have to navigate of perhaps some economic volatility. You can see that basically coming off of 1Q, where that ended up, we're fairly tepid, between 1% and 2% over the last couple of quarters. So something like 5.8 would represent a tremendous, tremendous boost on a short-term basis. Now, again, the devil is always in the details, and so we have to separate the euphoric benefit of AI from the rest of the economy. And we've got some data that kind of shows us these two worlds that we live in. So if we look at X AI, this is X computer equipment, software, R&D, blah blah blah. What we're seeing is not as much growth, real GDP growth. Now, if we go and look at the part that is really serving the AI, mouth right now, that's growing at a tremendous rate. So if you basically dissect this estimate out, what you're getting is that, like in this estimate, uh, from EPB, which is driven by Federal Reserve, BEA, BLS data, and census data, et cetera. Basically, for the most part, the economy is generating somewhat tepid growth, but it looks great because of what's going on in the AI sector. Now we talk about national debt, something to keep on the radar screen. Yeah, I just don't see any impetus to want to control this right now. We've added 3.6 trillion, as the Charlie Bolello chart here that you're looking at suggests, in just 1 year. And again, there's nobody really talking about this. They really should, because our interest burden is moving up as well. Something else I've been following is the whole credit market, and we talked a lot several months ago about private credit and some of the challenges it's had, real and perceived, and some of the misconceptions there that have led to a lot of sell-off and redemption requests in the private sector. But overall, as it relates to credit, as you can see here, and I wish I had more slides this week on this, but you can see bank lending as a share of corporate debt has really gone down. So again, you think about private credit serving as like the non-bank lender, and we've talked about that for many years now, but that's a real thing. And so commercial banks are fighting for market share here, and right now it's a losing game to some of the off-bank channels and private credit and these LLPs, LLCs, so on and so forth. Now it's time to talk about the equity markets, and I think we've got one chart on fixed income here coming up. But again, I'd say AI continues to drive this euphoric bandwagon. The one thing that I've articulated to our clients over the last month is, I do worry about some corrections. Is the system broken? No, absolutely not. But I've seen this before. I've seen where euphoria just picks up steam and it's a self-feeding frenzy. And you can see here in this chart, B of A bull bear indicator. I mean, this is an extreme bull territory. And I think there are things that are priced for perfection. Again, the earnings estimates, as we'll see here in a second, continue to move higher. I mean, in a parabolic fashion, which is very unusual. And so any little maybe perception of this cycle not continuing at its current pace, I think would be viewed negatively. I think you'd have this kind of almost cathartic reaction that could lead to maybe 5 to 10% correction. Again, volatility is a price that you pay for long-term performance from risk assets, right? And so, if we want that, that 10%, just to kind of put it to the nearest 10, the nearest percentage point, like just say, to get a 10% annualized return, you have to accept risk. And there are times, as I've mentioned to a lot of clients recently, where we haven't had a lot of volatility and you get comfortable and you're like, oh, well, this is the new normal. And then you realize, okay, well, valuations are pretty high. So let's just be eyes wide open and understand that that's a part of the investing motif here. So talking a little bit about valuation here, I think it's important to kind of look at the trend line. You can see here you're trading a little bit over 20 times. You can see going back to 1960s how these things are inherently cyclical, and so we've talked a little bit about the risk in the market, and we're trading. We're not on our peaks. But we're certainly above our standard deviation here, which just means that basically, essentially 2/3 of all observations on price to earnings are going to fall within this band, and the average being around 15 times earnings. And of course, we've seen earnings accelerate. And again, we'll talk about that in a second, but that's actually brought our earnings multiple down, but it's still high, and valuations are still high, and we've still melted up in this environment. And if you slide over here and look at these different valuation metrics, whether you're dealing with forward or trailing price to earnings or trend PE, or even the cyclically adjusted price to earnings, or what we call the Shiller PE, price book dividend yield, really everything except for this implied earnings growth, these represent long-term bands, and we're well over, in some cases, well over historical valuation trend lines. And so again, I just worry about the implications of having having valuations be relatively high if for some reason confidence shifts a bit in the market. And confidence honestly doesn't have to vaporize in this whole story of AI and how it's going to feed all mouths, and so to speak, but it just has to, all we have to have is just, I think, a shift in confidence. Like maybe the value proposition is pushed out like a couple of years, or you've seen how the market's reacted when people talk about the Chinese LLMs maybe gaining share in terms of tokenization, and that causes this kind of visceral reaction in the market. So it's not going to take much to introduce a little bit of volatility into the equation. Here we have some data on earnings, which I think is good to look at. We'll come back to the left side, but the right side here, here's the consensus earnings growth. Again, just over the 12 months, looking over 20%. Long-term growth rates looking very strong. Again, this is the line of best fit right here. And so we're seeing a very strong impulse right now from confidence. And you go back to pre 2000, there are periods where we had this kind of euphoric 12-month consensus earnings growth estimate, and then 2020, I'll discount this because it was the pandemic. But we really don't see this blue line hit where it is now. Long-term growth rates are extraordinarily high, but as I've said before, going back over here, that had you bet against earnings growth, you would have been a big loser. And here we can see here, just going back, this is 2009, and just over the last several years that you've had average beats in sales and earnings be above their trend line, particularly over the last 2 years. This is beating on earnings, and this is beating on sales, so not so much there, but certainly earnings beats have been better than the long-term averages. Not sure that there's really a whole lot to add to this chart than the story that it tells you right here, and you just see that concentration amongst the 10 largest stocks in the S&P 500 is over 80%. So when you think about, well, what matters in the S&P 500, it's clearly going to be those stocks. It's going to be, and there's certainly a heavier influence from technology in that basket. And there's a lot of stocks, frankly, in the S&P 500 that just don't matter. And we're just not seeing margin improvement necessarily from those categories. We'll talk about that in just a second. So we've been talking about earnings growth, and to have earnings, you have to have profits. And here's profit margins, net profit margins. You can see kind of how this is played out, at least from an operating margin standpoint and net profit margin standpoint. We've had this parabolic move, and this sounds great. Long-term averages. Actually, we felt really good back, in last year when we were hitting record high margins. We didn't realize that we were going to see this, but again, remember what I just said about the concentration of the top 10 stocks in the S&P 500 here, and this is not your father's index anymore. This is a result. Even the volatility of margins is going up because of the concentration of influence by these top companies, and many of which are in the technology sector, and many of which are benefiting, at least in the short run here, by this AI, capital spending boom, etc. So every story has its underlying components, and I think this is unmasking what I just got through talking about, like not getting carried away at these euphoric increases in margins. You can see here the Magnificent Seven, which honestly, we look back last year, they didn't really perform very well, and they underperformed the rest of the market. But clearly, they were getting too stretched, and they had to retrench. But profits remained strong, and here's your profit margins in the Mag 7. And if you go and look at the rest of the S&P 500, like basically the remaining 493, look here, margins are really flat. And again, you would expect limited volatility here. Again, this is pandemic, so pay less attention to this because of this, the kind of the cause and the response here. But margins have remained flat while these margins have gone up. And so when you think about that last chart where profit margins are moving higher, it's because of this. It's because of the concentration at the very top. So when you talk about this concentration, this adds more fuel to that argument, where the rest of the market is kind of really just kind of dragging along. So you've got utilities, consumer staples, industrials, and financials here. And in some cases, you do have some margin improvement, but if you look at consumer staples, margins are not moving higher, industrials not really moving higher. You can maybe argue that there is some improvement there, but it's not robust. It's not what you would expect, in that parabolic rise that we saw several charts ago. I mean, we obviously now know where that's coming from. And so, while this doesn't paint a necessarily bad picture for the rest of the market, it's just obviously not what's driving things right now. Final chart here is, looking at fixed income. So we have essentially a 5-year treasury between 4 and 5% right now. We've got rates that have moved higher, likely to stay higher for longer because you've got a longer end of the curve that's now pricing in a bit more inflation, long-term inflation, and beginning to price in the issue with this long-term debt that we talked about earlier in this chart pack, where we've added 3.6 trillion of new debt in the last year, and that's causing a increase in the term premium, obviously in a bit of the credit premium as it relates to treasuries now, because obviously treasuries have now lost their AAA rated status, and we all know what's going on in Washington these days. However, having said that the range of forward returns based on a treasury market that's sitting where it is now, it tends to skew fairly well. I mean, it tends to look in the range of forward returns. These would be negative returns. These would be positive returns. And so you get a little bit of a skew here. And so, this is really kind of speaks to what traditional fixed income would look like. And again, we used to think about fixed income in the context of a 60% equity, 40% fixed income portfolio, and the equity part of that was the S&P 500, and the 40% was in treasuries. Well, we don't think about that anymore. And even though you get a skew of positive returns here based on where rates are now, but they're not exorbitantly positive. And so this is just one thing that I look at that tells me you can't get excited about the 60-40 model that it existed like 20 years ago. You have to think about allocation and diversification completely differently now. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon.